Well, hi everyone. Thanks for tuning into the Franchise Essentials webinar. Today we're going to be taking a quick look at some franchise model analysis. So if we get underway, what we'll be covering off today, we'll start off with something that I call the Franchise Happiness Index, and that really sets the scene for why this sort of analysis is so important, why we undertake it, and how it can underpin success in the franchise space. We're then going to dive in and have a look at an ROI model and understand how we can take how we can work out what a required return on investment for a franchisee, what that actually looks like, and then how we can tie that back to some sales targets. We're going to uncover 5 steps to determine how we actually go about determining what that minimum sales amount actually is, and then we'll finish off with some practical scenarios and examples. Let's get underway. So as I alluded to earlier, this is what we refer to as the Franchisee Happiness Index. And this really underpins a lot of what we see out there in the franchise space. There is a big difference between the brands out there that are doing well and getting it right versus the ones that tend to be struggling. So if we just look at what happens where, franchisees are in an unhappy space, they're struggling, they're really challenged with a business model that's ultimately not working for them. There's a number of things that can come to the surface from that ultimately sort of destroy value. So if we look at sort of franchisees, abandoning stores, not renewing for subsequent franchise terms, or ultimately going bankrupt. From the franchisor perspective, there's also related to that an inability to sell subsequent franchises, which obviously impacts their profitability as well. We find also that there's limited financing options for franchisees. There's challenges out there in the market to secure finance for these brands. Litigation and mediation as well. If we have franchisees out there that are investing, their own funds into these businesses, when it does go awry, they will seek recompense against franchisors. Poor supplier relationships are another sort of common aspect of what can happen where it can go wrong. Cash flow dries up, and so franchisees are not able to have really sort of set and look after their suppliers in an appropriate way, and consequently vice versa. Landlords as well also feature in the space, excluding franchisees from premium sites or charging a premium for access to certain sites. Again, knowing full well that the brand probably doesn't have the best reputation in terms of ongoing success. Also, staff and fair work issues are common as well, and again, largely driven by that crunch around profitability and cash flow, and understanding as well in the environment currently where franchisees can actually be tied into that as well. If franchisees rather are not paying out their super as required, the franchisor can actually be held liable for that. And if that does come to pass, that can cause challenges where franchisors regularly need to satisfy solvency requirements. Look, on the other hand, where it does work well for happy franchisees, you've got franchisees owning multiple stores. If it works once in one store, then they, and it's profitable for them, then they can go on to seek additional stores and open up additional ones. That along with that comes a strong pipeline of franchisees as well. The brand has a good following, and there's more franchisees that are lining up wanting to take part in the investment. You have a strong history of renewed agreements off the back of that, and consequently, landlords get in on the game as well, offering premium sites for certain franchise brands. Access to bank funding is a lot easier for franchisees, and we'll have a look later on in terms of how that can impact our model. Better supplier terms as well. With suppliers, which can assist in terms of margin and overall success. Little to no litigation headaches as well, which is obviously preferred for everyone, and profitable franchisors on the back end that ultimately enjoy exit and investment options, and ultimately that drives a strong, recognisable brand, which is really what sort of franchising is all about. So when we sort of look at that and underpin and go back to understand what is the difference between unhappy and happy franchisees, often franchise profitability plays a key role. And that's why really looking at the underlying business model from an ROI perspective is so important. So let's have a look at that model now. We take a look at the financial feasibility of a potential business model, and we need to understand several areas. We need to understand from the franchisee's perspective, what is the investment that is required to actually get on board as a franchisee. Then we need to understand how that investment is actually going to be funding, what sort of funding and debt levels are likely to be incurred, what are the costs associated with getting that funding, and that will ultimately drive benchmark returns that a franchisee could expect, okay? And that's made up of two key areas. They'll need to be paid a benchmark salary, particularly if they're working themselves, if they're a working owner within the franchise, and also to understand their return on investment. So really just to summarise, insofar as that model says over the term, the initial term of franchise, we'd expect franchisees to be able to recoup their investment. They'll also have to service the debt and any interest on debt that they're borrowing to get into the franchise. If they're investing personal funds into getting into the franchise, which is often the case, they're going to want to earn a return on that and earn a benchmark salary as well. We put all of those four things together, and that's going to drive the annual profit that we should be seeing falling out the bottom of these franchises. So let's take a look. So if that's how the ROI, what drives the ROI, we then need to be able to go a step further and understand how that's going to drive the required sales so that these franchisees can be successful and meet that ROI target in terms of profit. Okay, so that's basically just sort of working backwards from that net profit that's required. We will have a look, obviously, at the operating expenses that can be expect to be incurred. We also need to have a really good understanding for the cost of goods sold, the margin that these businesses are operating, and then also understand and factor in the franchise and marketing fees that are going to be incurred as well. So we put that all together. That allows us to work backwards and understand the minimum sales that are required to achieve franchisee success. And then ultimately, when we come up with that figure, it's standing back and sort of saying, well, are the sales required achievable? Right, let's have a look further. So we start off with, as we said, the investment. What does the investment actually look like? Well, often with franchises, there's going to be an upfront franchise fee that we'll need to factor in. If we're going into a site, particularly in the retail environment, there'll be fit-out costs that need to be factored in. There'll be a rental bond or bank guarantee for taking on the lease of the site that we'll need to include. Inventory, how much are we going to have to pay to make sure the shelves are filled before we open the doors? There'll be some professional advice and setup costs, legal and accounting costs to get the business set up and ready to operate. There'll be supply guarantees that we'll need to look through and understand before business can commence, and also working capital will be required as well, and that's traditionally looked at as just how much additional funds are going to have to be invested in the business from the day the doors open until the business ramps up business activity and sales sufficiently to earn enough profit to be able to break even. So the rule around all those investment costs is that they must be recovered over the term of the franchise, and that's often 7 years. It varies franchise to franchise, but that's a good rule of thumb to work with in this example. So if we flesh that out into an example, what it looks like in reality, we could have a franchise fee for a business required to pay to sign up of $50,000. There could be additional setup costs in terms of the accounting and legal work I mentioned coming in at $10,000. Let's assume the fit out for a new site is $350,000 and it requires $150,000 worth of stock as well, just to fill the shelves. So that gives us some investment costs of $560,000. In addition to that, we'll have a look at some bank guarantees that need to be in place. So the wholesalers will supply to you $20,000. There'll be a rental bond as well to take over a lease on the premises of $30,000, and let's assume that working capital comes in at $80,000 to fund the business from the day it opens until it starts to turn a profit as well. So that would then take us to total costs of $690,000. Now, as we're trying to recoup that investment just over the first term, we are able to anticipate some refunds. Conservatively, we would say 50% of that $150,000 stock would still be available. Assuming that we're able to get the whole 150% is probably a little bit of aggressive. It's useful to allow some obsolescence in there. And also, let's assume that the bank guarantee to the wholesalers and the rental bond is refunded over the ordinary course of business. So in that scenario, that would give us a net investment to be recovered over the first franchise term of $565,000. Okay, so now we know how much the investment's actually required. We need to have a look in terms of how it's funded. Practically, look, strong franchise groups will support their franchisees to debt fund at least 50% of their business. Through our contacts in the banks and finance space, 50% is what they will commonly look to fund. Some major national groups that have a really sort of strong track record of success and are really well known can be higher than that. It can go as high as 60% or perhaps higher. Likewise, the poor performing groups may not be able to access funding outside of banking facilities that are secured by other assets. That's traditionally the family home. So based on that, we will have a look at what can be financed, and the balance obviously has to be financed by the individual franchisee stumping up some funds. Recognise that as equity as well. So for this example, let's say that we can achieve 50% debt funding. The interest on that debt is going to be at 9%, and the franchisee is therefore kicking in 50%. We'll also assume that the franchisee should be looking for a 25% ROI on the equity that they're kicking in. And again, that varies from across different franchise brands. 25% is a good rule of thumb. Look, 50% for the early stage or unproven franchise models, and it goes down lower to sort of 15% for the really well-established global brands. Good example of McDonald's. What is McDonald's? And what we're talking about there really is just in terms of risk and reward. If there is a higher risk associated with supporting and getting involved with a franchise, there's a corresponding higher expectation in terms of return on investment on that equity. Okay, we also need to factor in a benchmark salary. It's common with franchisees that the franchisee will also be the owner, operator, or the manager of their own store, and they should be paid a benchmark salary. And that is in addition to making the ROI on their investment they're stumping in. For specialty retailers, which we'll use for this example here, we'll benchmark that at $68,000, including super per annum. It does vary across groups. And in practice, we'd recommend a separate benchmarking exercise be done just to make sure that the salary figure we are putting in is commensurate with the roles and responsibilities that are being undertaken. Okay, so we put that all together for this for this example. If we're looking to recoup the investment that we looked at earlier, that's going to work out at $80,714 per annum. We can also calculate the ability to service that bank debt, so the interest portion at $17,323 per annum. If there is an ROI of 25% on 50% of the overall investment that the franchisee is putting in, that looks like $86,250, and we'll work with that benchmark salary of $68,000. So in this scenario, that would come up and suggest that there needs to be an average annual profit for this franchise operation of $250,000 per annum. But we also recognise that profit. The reality of profit is that it won't be the same every year. So the total profit over the life of the franchise, if we apportion that over 7 years, would be $1.75 million. Now that we've confirmed that our average net profit, or our target of what we want to earn, is going to be $250,000, we can now work backwards and reverse engineer that and effectively equate that back to what we need to do in sales. So our first step of that will be to look then at the annual operating expenses for the business, and we'll start with a a good review of what the monthly expenses look like. What we would traditionally do for franchises working in retail is first and foremost exclude the manager's wage and on costs, as this has already been accounted for in the franchise average annual profit calculation, where we made sure that there was a benchmark salary in place. If the business is pre-franchise, we would also exclude any head office marketing or management costs, because ultimately they're going to be picked up via the franchise and marketing fees piece. Would include any franchisee-specific running costs as well, such as the bookkeeping piece, compliance costs, licensing and registration. Would have a look through all other standard overheads, including the rent, related outgoings, electricity, and then ensure that normal running costs are in place as well. A big one to include would be insurance, full cover required by the banks if you're going through a lending scenario, to make sure that they're happy. We'd include software costs, repairs and maintenance, staff amenities, uniforms, and the like. So once we pull all that together, let's say for our example that we've gone through and estimated our monthly costs at $20,000 per month, so that would equate to $240,000 per annum. Next thing would be to look at the gross profit percentage that could be achieved, and we take an estimate on that, but it's critical that gross profit percentage is accurately estimated, as that even 1 percentage point movement can have a really significant impact on the minimum sales that are actually required. We also make sure that the GP percentage used has an allowance in there to include any stock leakage, and wasted average calculations are picked up as well. But for our purposes here, we'll go ahead and estimate that the GP percentage, after taking all that into consideration, is 32%. The next step will be to look at the franchise and marketing fees. So these are the fees that are charged to the franchise for franchise support services and to operate a valuable marketing fund. So we'll take a look at that through BDO. I mean, we benchmark a lot of these fees, so we have a good feel for what's happening in the franchise environment. And franchise fees for specialty retail operators, would benchmark that at 6% with a corresponding marketing fee at 3% to give us 9% all over. And we'll have a look later on in this discussion where we explore franchise fees as one of the critical levers that we can explore as well. So once we pull all that together, a net profit, operating expenses, a cost of goods sold margin, and allowing for the franchise and marketing fees, we come to minimum sales required of $2.1 million. So it's important to emphasise that figure in the workings to date are all exclusive of GST. We would make an assumption on GST thereon to gross it up, and in this case we'll say that GST applies to 50% of the sales. So the minimum sales required to get from the customers over the counter will be $2.2 million. Okay, and once we're really comfortable with that figure, we can start to work with that and start to say, well, okay, based on an average sale, if we had some data available, and we understand that for the group, the average sale per customer operating these franchise businesses is around $20 per customer. How many customers are required? And based on those numbers and operating a standard amount of days and weeks during the year, we would have to achieve 314 customers coming through the store each day. Per month, we can gross that out up to just over 9,400. So we can start to play with that data, but the key question to ask at this point is then turn around and sort of say, well, look, are these sales achievable? Are we going to be able to generate this sort of business activity to meet that average net profit based on the other assumptions within this model? The other thing we would do at this point as well is actually undertake some store analysis. So if the franchise group has a number of operating stores, let's see what their monthly and annualized turnover looks like in different locations. They could be operating under different models as well, but it's a really good comparatives and sense check to sort of say, well, look, if we're chasing 2.1 mil, we should be how many of these stores are actually being able to achieve that? And then it becomes a case of sort of saying, well, look, if a lot of the stores aren't actually going there, how do we then close the gap? What do we do about this? How do we what levers, if you like, can we pull to make this franchise model work more successfully? So when we look to refine the operating model, we run a bunch of scenarios and we look at key levers in the business and actually brainstorm with the franchise in terms of how this might be achieved. So key questions that we look at, we'll always start with the GP percentage. Is there a way to increase it? Is there a way to sell more products at a higher margin? Is there a way to perhaps improve our sales mix that's currently being achieved as well? So we'll review those areas. We'll also have a look at the rent and fit out. If you recall, any sort of fit out or initial stock that was required goes into those initial investment calculations that we do. So if we're able to decrease that obviously decreases the amount that we're going to have to borrow from the bank and service and pay interest on. And it also reduces the amount of the investment from the franchisee that requires an ROI as well. So are we able to cap rent? Are we able to identify some better rent scenarios? And are we able to reduce the spend on fit out and stock that's going to need to be financed through the life of this franchise as well? And this often will drive optimal store site selection for the franchise group as well. We'll also review opening losses. Is there a way that we can enhance the marketing or accelerate the ramp up of sales from the day the doors are first opened to the point where the franchise starts to break even and earn a profit? Obviously, if we can reduce that, that's going to reduce the amount of working capital that is going to need to be invested into the business as well, which again reduces the demand in terms of ROI and profit ultimately to achieve that. Wages is another big area as well, and we will review that piece of the business comprehensively. Is the wages model correct? Do we have the right staff on at the right rates at the right time? Is there a way to optimize that wages model? Are we able to ultimately optimize the mix of staff that we've got working at the right times as well? And ultimately, once we go through all that and see what else we can improve, we will have a look at the franchise fee model as well. So say it has been benchmarked by what a lot of other franchises do, but at the same time, if the overall franchise operation wants to succeed, ultimately it needs to be able to set franchise fees at a level that are commensurate to ensure franchisors can succeed, so that we have a harmonious relationship and ultimately a successful brand at the end of the day. So look, I hope you've found that brief webinar and insight useful and enlightening. It is a key part of what we do when we work with franchises. As I say, it really does sort of set up the relationship. And if you're keen to find out more, that little piece of model analysis is going to be a component in some franchise training that we're going to run later on the year on the 28th and 29th of October, where we run our Franchise Business Essentials course. It has been designed as a bit of a response from the outcomes of the recent franchise inquiry. We're going to have a look at some of the key findings and implications. We're then going to learn how you can analyse your own franchise and the underlying business model, just as we've done there, and understand exactly what are the business operating model constraints that you're dealing with and opportunities, and then how do you go about succeeding from there. We'll then be flowing through and having a look at the opportunities in terms of business planning, the power of leveraging a coherent strategy into a business, what that looks like and how we've done that with some of our more successful clients, the value of benchmarks for franchises and how that can help enhance performance. Day 2, we'll be having a deep dive into best practice stock management and the value of effective supplier relationships, which are critical, particularly in the franchise space and in the retail space. We'll also have a look at some insights into measuring monitoring and motivating your staff as well, which was a key component in that model that we just looked at. We'll also be bringing in some legal context to really understand how franchises can successfully navigate the legal environment and what some of the challenges are out there today, and then pulling it all together. And really the benefit of this course is being able to go through those areas, understand what the challenges are for your business, what the opportunities are out there as well, and how we can pull it all together for you to optimize your future franchise relationships as well. So if you're interested, would love to see you along there. Thanks for tuning in, and I look forward to catching up again soon.